Hello, everyone. It's your host, Daniel Litwin, the voice of B2B, and welcome to another episode of E2B, Energy to Business, an opportune podcast. Thanks again, folks, for tuning in as we continue to explore larger trends, topics, technologies, and some of the most important market-moving factors that are shaping the larger oil and gas and energy industries. Now, if you are listening along to today's episode, things probably sound about the same. However, if you are watching along, well, that's new in and of itself. We don't often do a lot of on-camera versions of the podcast, so we're hoping to do more of these, and we hope you enjoy seeing the opportune team this time around for some more quality thought leadership from an opportune perspective. So thanks again for joining us. And as you listen to today's episode, make sure that you're heading to our website, opportune.com, for not only more episodes of the show, but other important resources like blogs, articles, videos, and white papers. And you can also learn more about some of our solutions and services, as well as find supplemental content surrounding today's topic. You can also subscribe to E2B on Apple Podcasts and Spotify, so just hit that subscribe button and you'll have a full catalog of previous conversations, plus notifications when we drop new episodes. So today's episode of the show is a little different, not only because we have a video component running, but also because I'm only going to be doing the intro and outro here today. We actually have a different host who's going to be guiding the discussion. Her name is Katie Rose Hurd. She's a director at Opportune, and we figured we would mix things up and really expand the scope of perspectives that guide our conversations here on the show, especially when our conversations turn more internally. So we're going to be sitting down with Katie Rose Hurd as our host, and she's going to be interviewing Steve Hendrickson and John Beaird, two professionals at Ralph E. Davis, an Opportune company. So without further ado, let's go ahead and pass it off to Katie Rose. Katie Rose, take it away.
Hi there, I'm Katie Rose Hurd, Director in the Processing Technology Group at Opportune, and I'm excited to be speaking with you, Steve and John, who work in a very different aspect, service line of our firm, and learning about your backgrounds and experiences and your thoughts on current events. So thank you for your time today.
You bet. You're welcome.
So I first wanted to dive into what the two of you were up to before you joined Opportune. Steve, would you mind starting and giving us some insight into your journey?
Yeah, sure. You bet. So, John and I both have lengthy oil and gas careers, over 35 years each. We spent a lot of time working for operators around different basins in the U.S. But immediately prior to joining here, we had both been engaged in doing some consulting. We were working together before we were here. We both came out of a private equity world, if you will. And I think I can speak for myself and get John to elaborate as well. But when I left that previous role, it was around 2015, and the private equity markets had tightened up quite a bit. There weren't as many opportunities to reform an entity, and so I turned my career back into consulting, which I had done several years ago, and that's how I crossed paths with John.
John, what about you?
I had the same experience, Katie Rose. Had just finished up in 2014 a private equity-backed venture, and then was looking for the next best thing, and found that getting recapitalized and getting a new team going, it just was a lot harder than it had been in the past. There was a lot of guys and gals looking for money, and I kind of turned back to consulting. And as Steve mentioned, was blessed to run into him and do some deals, and kind of started from there. It's been pretty good.
Yeah, we've had a really good relationship over the last, I guess it's 5 years now. Back then, we were did quite a bit of buy-side evaluation, particularly for mineral and royalty buyers. There are a lot of people that strive to invest in this space. And of course, it's a very technical topic, right? And trying to understand how wells are going to produce in the future, especially ones that haven't been drilled, requires a lot of engineering and geologic expertise. And so we had a number of clients turn to us to help us evaluate transactions on their behalf.
I think one thing that we picked up then that we're expanding on now is we were dealing with a lot of clients, if you will, that really weren't that familiar with the oil and gas space. They were trying to invest in it anyway. And so we went above and beyond, if you will, to try to explain to them what they were getting into, to give them a little bit of comfort they were making good decisions. And we continue to do that today with all our clients.
So what would you say are the major differences between kind of, and you've touched on it a little bit, but what are the major differences between kind of what you were doing in sort of maybe the past 5 to 10 years versus what your type of projects you're primarily working on right now?
Right. Well, we've kind of been through an evolution here at Opportune. So when I joined, and John as well, back at the beginning of 2019, it's been the world was pretty much the same as it had been, I guess, prior to the same as what it had been prior to coming here. And but it wasn't long after that we had a lot of change in the industry. And you may recall that the latter part of 2019 and all through 2020 was one where a lot of companies found themselves in financial distress. Prices were dropping. Companies had a lot of debt. And there were a lot of bankruptcies as well. And that was an area that Opportune, as a broader firm, was really active in. We had a restructuring group at the time that I've heard at one point we may have had 70 people working on different transactions at once. And I know that we worked on about 24 during that time frame.
I got pulled into some of that too.
Exactly. I think we had everybody we could that, could help out was involved. And so that, especially for us, we started to work on things or look at things from a perspective that we maybe were accustomed to looking at from a operator's perspective, from an owner's perspective, but weren't necessarily the ways that things that from a banking perspective that they were looked at, or the ways banks had looked at them historically. So just maybe to set the stage a little bit more, we as a restructuring firm, we would represent lots of different participants in those disputes, I'll say, for lack of a better word, or those problems. Sometimes we represent the company, help them work their way out. Sometimes we represent their lenders, and sometimes it's just somebody else, another stakeholder. And so we found that when John and I and our team got heavily involved, it was usually when we were representing somebody on the lending side. And for the most part, whether those were in bankruptcy or just in a distress situation, they might have migrated from their normal their normal origination and commercial lending team to one that's more accustomed to dealing with distressed or workout situations. And those teams didn't typically have a engineering arm or any engineers on them. Not to say that all of them didn't, but typically there were no engineers on that side. So that was our role, was to come in and try to help them understand the nature of the assets. Number one, we would review the reserve reports that they were getting from the company, scrutinize those, looking for any potential issues with them. Maybe things weren't tying out to the history and the forecast didn't really match, and we try to understand why that was and figure out what we needed to do to make those match better. I think we also spend a lot of time doing what I call educational things. And it really reflected, I think, in my mind, the desire, a shift amongst those participants to better understand the assets than maybe they traditionally had when they just received a reserve report from a third party, and they would do their underwriting based on that with maybe not as much diligence as I felt like they were going into during these tougher times.
I think that's a really good point. I mean, especially on the education piece, because we were getting a lot of questions that I typically didn't get when I was with private equity, when we would go through an RBL kind of review. They were mainly looking at the third party report and moving ahead. Now they had a lot more detailed questions on the assets themselves. And it made a difference being able to kind of hold their hand and walk them through that.
Mm-hmm. I know that there were a number of cases where in these distress situations, there may be, maybe folks would say, if we just put a little bit more money into this, we can work our way through it. We'll invest in this particular project, and that's going to have a nice return, and that'll get everything going again, and we'll, climb out of this. So we would get asked to review those sorts of recommendations. So the management team might be proposing to drill some additional wells, or maybe some other type of project that they wanted to implement. And our role would be to come in and look and see, how did we think those things would perform, but also what was kind of the range of outcomes that they might expect to see, so that they kind of knew what the upside and the downside were rather than just a single number. Plus, as we were talking about, this whole sort of education, being able to put things in terms that someone who's non-technical can better understand the technical aspects.
So how you've touched on it a little bit, but the past couple of years we've been through such big price shocks, big ups and downs, and we're seeing over $100 per barrel prices. And how has that changed or shaped things in the industry from a petroleum engineering perspective?
Right. Well, I think one of the things that we've been hearing a lot about for the last couple of years has been maybe a couple things. One is increased capital discipline. And there's an expectation that management teams will not just manage for growth, but will manage for returns and live within their cash flow more frequently. And that's a reflection of companies, or I'll say the traditional E&P investors, not wanting to continue to pour money, whether it's equity or debt, into a company just to chase growth, only to find out at the end of that their returns ended up suffering. So because the traditional, what I'm calling the traditional sources of capital, and that would be things like reserve-based loans from a commercial lending perspective, private equity for private companies, or public equity for your publicly traded companies, because all of those sources of capital are have been less available over the last couple of years, or available on tougher terms. We're starting to see companies that are striving to fill that void, if you will. There are sources of capital that are starting to become more prevalent in the industry, and a lot of those sources of capital don't have the technical background that the traditional ones do. And so as they start to put money to work, they have a lot of questions. And so we're finding that clients ask a lot more details. They want to understand the assets better than perhaps they did in the past.
And it seems like there are more investors in kind of niche parts of the industry, like minerals. Are you seeing this with your clients and prospective clients? And what differentiates these investors from traditional operators?
Yeah, we definitely see a lot of entities like mineral entities. Those have been on a tear really for the last 5 or so years. I got involved in minerals back in 2006, and it seemed like there was a big wave of new participants at that time. It seemed like it was, the flavor of the month, if you will. But I mean, it has gone an order of magnitude beyond that over the last few years, and we continue to see new entrants coming in. We also see folks that are playing that space differently than they used to. That is, maybe rather than just buying and holding for years and years, they buy and they wait for some particular event that might result in a value increase. Like let's say you bought some non-developed acreage, and then there were some permits, or some wells were spud on the tracks. They might sell at that point rather than waiting around for the wells to produce and just recover their capital that way. So it's gotten very dynamic. It's gotten more and more fragmented, I'd say. Not only do we see minerals buyers, but we're seeing a lot of non-op working interest participants. And from the standpoint of petroleum engineering, what I see with most of those type of investors is a lot of them do tend to be pretty technically, and I'll say data driven. That does seem to be a theme amongst a lot of them, is a lot of technical work to understand the production performance of given areas so that they can properly value the assets that they buy and when they sell. But it does seem like, so I wouldn't say that those investors are necessarily driving a new range of questions for us. Maybe the way it shows up for us is as we find that it's important for us to continue to develop our technical skills, our data analytics, so that we're able to, I wouldn't say compete, but we're up with the leaders of the pack, if you will. Technology in that regard continues to advance, and we want to be at the forefront of that. So not only do we develop our own ideas, but as we interact with people, we get the chance to see some of their better ideas, and we think, well, how can we incorporate those into the things that we do and provide to our clients?
So you used the term SPUD. Can you spell that out for me?
Sure. SPUD, S-P-U-D, right? Just to start a new well, to drill a new well, okay. Right? So as I was saying, as wells are developed, as acreage goes from something that has no wells on it to has a bunch of producing wells, it moves through a series of stages, maybe milestones that, well, somebody has to lease it, then there's a drilling permit, then a rig shows up and drills a well. And some of our listeners have undoubtedly heard of DUCs, which are drilled uncompleted wells. Eventually the well gets completed, placed on production. And each one of those milestones moves us closer to actually having cash flow. So the probability of cash flow goes up and the value goes up compared to an undeveloped tract, if you will. So we see a lot of folks trading around those events. It's a much more dynamic market than it was a few years ago.
And then a second question I had, me being in our Opportune's process of technology group, you mentioned business analytics and tools and things that you use. Can you kind of expand on that? Because I'm curious to what y'all are using to kind of analyze all of these wells and reservoirs.
Right. Well, most of what's happening, I'd say, not all, but most of what's going on in terms of data analytics in the petroleum or reservoir engineering space, not the whole petroleum engineering space, but with respect to reservoir engineering, has to do with the development of what we call type curves or type well profiles. What those are we use them in unconventional resources, which is predominantly what we're drilling today, to help predict the performance of wells that we have not yet drilled or wells that have only been producing for a short period of time, and we can't predict their future performance from their relatively short historical performance. And it's been a hot topic in the industry for 10 years. It requires a lot of number crunching, a lot of statistics. And it's like a lot of statistics, there's a lot of places to go wrong with it. There's a lot of places to make it, to use it to maybe justify a story that, that you have a bias towards. So we try to develop techniques using Spotfire and a bunch of other algorithms and Monte Carlo simulation in order to develop really robust data sets and analog sets that we use to predict what the future outcome might be of other wells, and not just predict maybe the expected value, the average value, but to really get a good understanding about what the range of outcomes might be, what influences that performance, how programs of wells reduce risk and to what degree, things like that. And as you can imagine, those can be pretty complicated topics. I mean, the math can get pretty heavy, and it takes, I think one of the things I pride our team on is our ability to take those ideas and boil them down into more concepts that are more easily communicated and understood by someone who may not have a super strong mathematics or statistics background.
Right. Okay, so I'm going to kind of shift a little bit with a different question. So you've mentioned a little bit that the finance and the upstream sector has pulled back a little bit on their investment levels. But now that prices have rebounded, what types of changes have you seen in the capital markets?
Right. So one of the things, and I'm going to let John elaborate on this because he's really been leading a lot of our work here. We've seen the rise of a debt type structure called an ABS structure, or an asset-backed securitization. I would not be surprised if a lot of the listeners and viewers have heard of those, may not know a whole lot about what they actually do. But there's a lot out there to read. I'm not going to try to provide a summary of what those structures are. But I'll say that the investors in a lot of those, in many respects, fall into those non-traditional roles. I mean, they are not the same folks that were necessarily reserve-based loan investors. They don't have technical teams. And so they get materials from the issuers of these securities, and they'd like some help understanding the assets better and confirming that the third-party reserve reports that come with those are consistent with the history. So let me pass it over to John and let him elaborate a little bit on the type of work he's done there.
That's quite a few of those have come through the door through the past several months. A lot of it's being driven by the fact that companies are unable to sell assets because of the price swings. And they're trying to find a way, one, to monetize those maybe, or two, to get lower debt than their bank debt. And as Steve mentioned, that individuals that are investing in those opportunities don't have the technical depth that they really want to have. And so they're looking for a team that can take the data that they're given and explain to them what they should be concerned about, show them what the risk may be, the ranges of these outcomes, so that they can make a more informed decision. And I think that's something that we're bringing to the table that maybe a lot of our peers aren't, is the level of review that we're doing for our clients to let them be better informed and make better investment decisions.
Yeah, exactly. We're really not in the business of telling people that this is a great investment or a poor investment, but we really do strive to help them understand the assets that they're considering investing in. And I think because we have both of us and other members of our team have extensive operational experience, we're able to think about the sort of things that would concern us if we were an investor, and make sure that as we're looking over the materials that have been provided, that we're looking for the types of things we would look for in order to help these guys and gals make better choices.
All right. Well, I think those were all the questions I had for you guys today in this discussion. Do either of you have any other thoughts or closing comments to add that you think would be important to the listeners?
Well, I don't know. We've kind of touched on it a lot, but it's definitely a dynamic industry, and we came through a period, I would say, post 2020, 2021, and really was kind of a year of reset in my mind. Is that we've talked a lot about. Well, I didn't really use the word, but kind of a little bit of a changing of the guard. Some people who were active in the space on the lending and on the equity side have chosen to not participate or participate at a much lower level. And now we have new entrants coming in. And that takes time for new participants to start to learn the business, to figure out structures that are going to work for their investment goals, and then to start to learn the business, as I mentioned. And so what we're finding is that looks like that revolving door has been spinning a little bit, and now things are starting to happen as really kind of picking up, as you might expect, from what I thought was kind of a slower year last year in terms of transactions and new ideas.
Yeah, definitely is.
And as you said, for these new entrants, part of y'all's role has been with recent projects is more kind of an educational guide, helping them learn the business and understand it, and so on and so forth.
Yeah, exactly. These are very savvy people. They certainly are experts at finance and in their field, and they do have experience in the industry to some degree. But there's a lot of technical topics here, and it's helpful to them to dig a little bit deeper on those, and so that when they are speaking internally with their committees or whoever their decision makers are, that they can be confident that they understand they're prepared to answer the questions that they have to answer. I think that's something that we really try to offer really across the board. We are not the kind of a firm that likes to just, we'll do some work, package up some numbers and send them over, and good luck trying to figure them out. Or we really want to make sure people understand how we derive what we derive. And, I think it's a lot of fun, frankly, to be able to help explain these things to people. It gives us a chance to talk about things that we're all very passionate about. But we also know that it's going to make them, hopefully make them make better decisions and feel more confident in what they're doing.
Yeah, that's the ultimate goal, is to get them to a point where our analysis is conveyed to them in a way that they totally understand it and make more informed, better decisions.
Right. Exactly. Well, Steve and John, thank you so much for your insight today.
Thank you,
I know
Kate.
I learned a lot. Appreciate your time.
Very welcome.
Well, thank you again to Katie Rose and to Steve and John for y'all's perspectives on the podcast today. Again, we hope to have Katie Rose hosting more episodes in the future and guiding more discussion with our opportune professionals. So thank you again to everyone on today's episode, including Katie Rose Hurd, Director at Opportune, John Beaird, Vice President of Ralph E. Davis, and Steve Hendrickson, President of Ralph E. Davis, an Opportune company. And that does it for today's episode of E2B, Energy to Business, an Opportune podcast. If you like what you heard and saw today, make sure that you head to our website, opportune.com, for more episodes of the show and other resources, as well as information on our solutions and services. And of course, don't forget to subscribe to E2B on Apple Podcasts and Spotify. I'm your host, Daniel Litwin, the voice of B2B, and we'll catch you on the next episode of E2B.